Today we're going to talk about the basic steps to calculate taxes. And please keep in mind in today's lesson that we are doing one day on taxes. If you go to school to become an accountant, particularly a tax expert, you will probably spend semesters, if not years and years, on taxes. So we're doing a very, very brief high-level overview. There's a lot more to be learned, but they don't teach this stuff in high school and it's very relevant to your lives, so we're going to at least touch on it. Alright, so the basic steps to calculate taxes. You start off with your gross income, and this is the amount of money that they tell you you're going to make at a job. I don't know if y'all have jobs, but it's always shocking when you're told how much you're going to make, and then at the end of the month you get your paycheck, and it's not ever what you thought you were making. And that's where this tax process comes in. So the gross income is the total that you make. And you start by subtracting out any adjustments that you have. And adjustments are things like money that you're putting into an IRA, tax-deferred savings. A lot of health plan savings accounts are tax-deferred, which means that you put money in there before you pay taxes, so you're not actually getting taxed on that money. That can be a huge savings to you if you have a lot of medical bills, is to pull that money out before you pay your taxes. So adjustments, it's pre-tax money that kind of gets to go where it's going without the IRS putting their hands in it. And then once you take out your adjustments, we call that your adjusted gross income, your AGI. And then from there, we take out things like deductions and exemptions. And we're going to talk about deductions and exemptions more here in a second. But once we subtract out our adjustments and we subtract out our deductions and exemptions, we call that our taxable income. That's the money that the government is going to take a percentage out of as your taxes. Once you know your taxable income, then you'll do a tax computation based on rates, which we're going to use a chart in your book to help us with, and this changes pretty much every single year. And that tells you how much tax you owe. You subtract from it any tax credits that you have. And you can get tax credits for a lot of things. A couple years ago when they did the cash for clunkers, you could get a tax credit for buying a new vehicle. Sometimes you can get tax credits for things like having children or putting solar panels up on your house. There's a bunch of different things you can get tax credit for, and you need to check with your accountant, but this is just money that's subtracted off your tax bill for the year. And so once you subtract out any tax credits, that tells you the amount of tax that you owe the government. And then from there, you need to take out any payments and withholdings. And this is the money that you've already paid in taxes that gets taken out little by little in every single paycheck. And so in April, when you calculate your taxes, what you do is you look at how much tax you owe, and then you calculate how much you've paid throughout the year. And if you have a deficit, you've got to pay the IRS more money. But if you've paid too much, then you get your refund check. Again, this is the very high level of how taxes are calculated. So for example, let's say that Mark earned $40,000 and he made $400 in interest from an investment. He paid $1,000 to a tax-deferred savings plan, and then he had exemptions of $3,000 and deductions of $4,000. We want to know what his taxable income is. So his gross income is the $40,000 he made from his job, and then the $400 that he made from his investment. So that is $40,400. Then to get his adjusted gross income, we take that $40,400 and subtract out the money he's putting away that's tax deferred, so that $1,000. So his adjusted gross income would be $39,400. And then from there, to calculate your taxable income, you subtract out the deductions and the exemptions. So $39,400 minus $3,000 minus $4,000 gives us a taxable income of $32,400. So he's only paying taxes on part of his income rather than all $40,000, really $400, since he made the money from his investment. So when you file taxes, you have to pick a filing status. You can either file single, married with your spouse, married separately, or you can file as head of household. And I think most people probably file either singled, married jointly, or head of household. Head of household might be like a divorce situation where you've got dependents, little kids that you're taking care of, or sometimes head of household could be if you're taking care of an elderly relative and they're financially dependent on you. If you're married, again, check with your accountant. I think most married couples file jointly, but sometimes, particularly if there's a huge deficit in incomes or people are trying to keep their finances separate, they might do married filing separately. So exemptions are a fixed amount that you get to subtract off from your taxes per person. So you get it for yourself and any dependents. So if you're married, you get to subtract 2 deductions because there's 2 of y'all. If you have 2 kids, you get to subtract 2 more exemptions because there's 2 kids. So every single person that you are financially responsible for, you get to subtract an exemption for. And in 2013, the exemption was $3,900. So you got to subtract that from your income right away. Deductions vary, and these are a bunch of different things. They can be things like interest that you pay towards your mortgage, money that you give away to charities, taxes that you've maybe paid to the state government. There's a bunch of different things you can get deductions for. And again, check with your accountant to see exactly what you can qualify for. But you have a choice. You can either itemize your deductions and say, I gave this much to charity, this much to my mortgage, and like list it all out and get a total. Or you can pick the standard deduction, which is a set amount, and it's given in the chart in your book. And the thing with this is you've got to pick one of them. So either itemize and add it all up and subtract that from your taxes, or you go with the standard that the government says everyone can subtract this from their taxes. And you want to pick whichever one is bigger, because that's subtracting more money from what you have to pay taxes on, and most people would rather pay less money in taxes than more. So again, you can either itemize or you can pick the standard deduction, but pick whichever one's bigger. You can't do both. So for example, in 2013, which is the chart in your book from the section that we're using, the standard deduction for a married couple was $12,200. So let's say we have a married couple and they paid $3,000 in mortgage interest, they paid $4,000 to charities, and they paid $300 in state taxes. So if we add up all of their deductions, that comes out to $7,300. Well, in this case, they want to go with a standard deduction of $12,200 because it's much bigger. That's subtracting more money off of what they're going to have to pay taxes on. So currently in the U.S., we have a progressive income tax, which means the more money you make, the higher percentage that money is taxed at. And you figure out your tax by looking at the chart in your book. And please know that on a test, we will give you the information you need for your taxes. You do not need to memorize this whatsoever. I'll be referencing the one in your book for these examples. I think in your lab book it gives you different numbers to use. So either use the one in your book or use what my math lab gives you or use what we give you on an assignment. So let's look at this. So Larry makes $60,000 and he's single. We want to know what is his taxable income. Well, again, we're using the chart in your book, and it says at the bottom under the single category that the standard deduction is $6,100, and then the exemption per person is $3,900. So since Larry's single, it's just him, he only gets one exemption. So he would take his income, his $60,000, subtract off the standard deduction of $6,100, and then subtract off the exemption for just him to get $50,000. So his taxable income is $50,000. Then looking at the chart, we see it says tax rate 10% up to $8,925. So that means the first $8,925 he makes is taxed at 10%. So he'll take his first $8,925 and multiply it times 0.10 to calculate 10% of that. Then looking down in the chart, it says tax rate 15% up to $36,250. So that means all the money that he makes above and beyond the $89.25 is going to get taxed at 15%. So we take all the money up to $36,250, so we see $36,250, and then we subtract out the $89.25. He's already paid 10% taxes on that first almost $9,000. He doesn't repay. So it's the $36.25 minus the money he's already paid taxes on, and that amount is taxed at 15%. But Larry has a taxable income of more than $36,250, so we've got to keep going. We see the next bracket, the 25% bracket, is up to $87,850. So he doesn't make more than $87,000. This will be his last bracket. So he's got to pay income up to $50,000 in taxable income. So we take his $50,000 minus the amount he's already paid taxes on. And again, he's already paid taxes on his first $36,250. So we subtract that away. And so all that surplus above the $36,250 gets taxed at 25%. And when we calculate all those values and add them together, we see that Larry has to pay $8,429 in taxes this year. Let's look at another example. And this is actually from your income tax lab. This is number 2. So it says Amy is single with a salary of $50,000. She has been offered a new position that will raise her salary to $53,000. The cutoff between the 18% and the 25% tax bracket is $51,250. How much will her tax liability increase if she accepts the new position? And this is actually a very typical problem that we might throw at you on a test or something, because it tests the concepts. Do you know how taxes are calculated without having way, way too much work. So that's one reason I wanted to do this one. So she makes $50,000. She gets the $3,000 raise, which gets her up to $53,000. We know the cutoff between the 18% and the 25% is $51,250. So we want to see how much tax is she going to pay just on the raise. So we're really just focusing on the $3,000 and how much of that will get taken in taxes. Well, her raise up to the cutoff, the $51,250, is going to be taxed at 18%. Then everything above and beyond that is going to be taxed at 25%. So we would need to see how much of her raise is below the cutoff. So we'd take the $51,250 minus the $50,000, because again, we're just looking at the raise. We're not really concerned with the first chunk of her income. So that first chunk of her raise from where she was up to $51,250 is taxed at 18%. And then everything above $51,250 will be taxed at 25%. So we take her total, which is the $53,000, subtracting off the $51,250, and that's going to be multiplied by 0.25 because that chunk is taxed at 25%. So the first part is at 18%, the second part is at 25%, and when you do that math, you see her total tax bill is $662.50. So she'll get a raise of $3,000, but she'll really get to bring home about $2,400 once the taxes are taken out.